Imagine receiving a significant sum of money as a personal injury settlement, only to find a portion of it claimed by taxes, a reality many aren't prepared for. The question, is your personal injury settlement taxable, is critical, yet often misunderstood. As you navigate the aftermath of an accident or injury, understanding the tax obligations tied to your compensation can save you from unexpected financial burdens. Many believe that all personal injury settlements are completely tax-free. But this is not always the case. The tax treatment of these settlements can vary significantly based on the nature of the injury, the type of compensation, and the details underlying the claim. We will untangle these complexities, offering clear guidance and actionable advice on handling your settlement with foresight. When you receive a personal injury settlement, the IRS categorizes the different components of the payment. Not all money received from settlements is treated equally under U.S. tax laws, which can lead to confusion and misinterpretation. Generally, the nature of the claim and the specific damages awarded determine whether the settlement is taxable or not. A crucial factor is distinguishing between compensatory damages, intended to compensate for actual losses, such as medical expenses and lost wages, and punitive damages, which aim to punish the wrongdoer. Only one of these categories typically enjoys a tax-exempt status, underlining the importance of how settlement agreements are structured. The key to managing your expectations and preparing adequately for potential tax impacts lies in understanding these distinctions. With proper knowledge, recipients can strategize their financial planning and avoid the pitfalls of unexpected tax liabilities. Compensatory damages awarded for physical injuries or physical sickness are generally non-taxable, as long as they don't provide a capital gain. This exemption applies to both lump sum and structured settlements. For example, if you are compensated for medical bills, pain, and suffering due to physical injury or any form of physical sickness, the IRS does not typically demand a share of that compensation. However, the exemption has clear boundaries. For settlements that involve emotional distress or mental anguish, not originating from a physical injury, the scenario changes. Though these damages may intuitively seem related to the injury, the IRS often considers settlements for emotional distress as taxable unless they are directly due to a physical injury or sickness. This particular segment of the law highlights the importance of detailed documentation and precise language in settlement agreements. If the compensation specifies that it is for physical injury or sickness, it's likely exempt. If not, one might find themselves obligated to the IRS. Not all components of a personal injury settlement are shielded from taxation. Lost wages, punitive damages, and interest on the settlement are generally taxable. For instance, if a settlement includes compensation for time you were unable to work due to an accident, those payments are considered as replacement for income and therefore taxable. Moreover, punitive damages are taxable regardless of whether they stem from a physical injury or not. Unique to U.S. law, these damages are intended to punish the defendant rather than compensate the plaintiff. Because they do not reimburse the loss from an injury, they do not qualify for tax-exempt status. Interest on the settlement also falls into the taxable category. If a settlement is paid out in installments over time, any interest earned during that period is considered income by the IRS. This is an often overlooked aspect that can surprise many settlement recipients. Understanding the tax implications of your personal injury settlement requires accurate information and sometimes professional guidance. It's critical to work with an experienced personal injury attorney who understands tax laws to structure a settlement agreement in your favor. A common misconception is that all elements of a personal injury settlement are automatically non-taxable. This misunderstanding can lead to unplanned financial liabilities when filing taxes. Always reviewing the specifics of your settlement agreement with regard to any taxable income can prevent unwanted surprises. This proactive approach not only protects your assets, but also provides peace of mind in your recovery journey. Understanding which elements of the settlement might be taxed ensures there are no surprises come tax season and allows for better financial planning post-settlement. While we all want to save money, and sometimes thinking we can do much better without an attorney to represent us is typically not to our advantage. Yes, they do get a percentage in most cases, but there is a huge value in hiring someone with personal injury experience. They are the ones who will structure your settlement in a legal way, as to not have you being taxed, and will truly be looking out for your best interests. Please take a moment to like, share, and subscribe, as it helps us immensely.